In February 1946, the United States owed $269 billion, 119% of our entire economy. By 1960, that number had barely changed at $286 billion, yet the debt-to-GDP ratio had plummeted to just 55%. Our government didn't pay back a single dollar. They did something far more elegant. They made the debt irrelevant, and they're about to do it again. What if I told you there's a financial playbook our government has used before? One so effective it erased half our national debt in just 15 years without ever making a payment. You won't find this in economics textbooks, and most Americans have no idea it even happened. But the infrastructure is already in place, the mechanisms are warming up, and your savings account is about to fund the greatest wealth transfer in modern history. Picture this: April 1942, the Federal Reserve Building in Washington, D.C. Mariner Eccles, Fed chairman, sits across from Treasury Secretary Henry Morgenthau, Jr. They're not discussing military strategy. They're engineering the greatest financial magic trick in American history. The deal they're about to strike will quietly transfer hundreds of billions of dollars from everyday Americans to the government over the next decade, and almost nobody will understand what's happening until it's too late. Here's what they agreed to that spring morning. The Fed would cap Treasury bond yields at 2.5% for the duration of the war and beyond. Sounds technical, right? But here's what it actually meant. With inflation running at 6 to 8% annually, every American who bought war bonds was losing 3 to 5% of their purchasing power each year. You lend the government $100, they promise you $102.50 back. But that $102.50 only buys what $97 would have bought when you started. The deal remained in place for 9 years. They called it patriotic. They called it supporting our troops. What they didn't call it was its real name: financial repression. The government's secret weapon for eliminating debt without default. Let me show you how this actually worked with real numbers. Between March 1942 and March 1951, the Federal Reserve maintained that ceiling on long-term Treasury bonds at 2.5% under direct Treasury control. During this same period, average annual inflation ran at 5.7%. Do the math. Real interest rates averaged negative 3.2% for nearly a decade. Think about what that means. The government borrowed $200 billion to fight World War II, while ensuring that every bondholder was systematically losing purchasing power year after year after year. But here's where it gets really interesting. From 1946 to 1955, total U.S. government debt remained nearly flat, hovering between $270 billion and $275 billion. Yet during that same period, the debt-to-GDP ratio crashed from 119% down to 71%. A 48 percentage point drop. How is that even possible? The mechanism was brilliantly simple. Nominal GDP grew from $227 billion to $415 billion, an 83% increase driven heavily by inflation. Cumulative inflation over this period hit 44%. Every dollar of 1946 debt was now worth just 56 cents in real terms. The government didn't pay back the debt. They devalued it into irrelevance while our economy grew around it. Think about your grandparents or great-grandparents who bought those Liberty bonds and Victory bonds. They thought they were making a safe investment, supporting their country, securing their future. Liberty bonds sold during World War I at $100 face value were worth approximately $47 in inflation-adjusted dollars by 1951. The World War II bonds fared even worse. A $100 Series E bond purchased in 1942 and held to maturity in 1952 returned $133 in nominal dollars. Sounds like a gain, right? But with cumulative inflation of 48%, the real return was negative. Your grandparents got paid back in dollars that bought less than what they originally lent. On April 9, 1951, something changed. The Treasury Federal Reserve Accord finally ended the Fed's obligation to support Treasury prices. But by then, the damage to bondholders was complete. The magic trick had worked perfectly. Our government had financed the most expensive war in human history and emerged with a debt burden that was already melting away. Now you might be thinking, that was wartime, an emergency measure, a one-time thing. But here's what should grab your attention. This wasn't a bug in the system. It was a feature that's been used repeatedly throughout our history. The infrastructure built in the 1940s became the template. Federal Reserve cooperation, interest rate manipulation, captive domestic buyers through banking regulations that forced institutions to hold treasuries, and systematic currency devaluation through inflation. The government doesn't need to pay back debt in any meaningful sense. It only needs to manage the debt to GDP ratio. The playbook is elegantly simple. Suppress real interest rates below the rate of economic growth, especially inflation-driven growth, let nominal GDP expand faster than debt levels, and watch the ratio compress. Who pays for this? Bondholders, savers, anyone holding cash or fixed income investments. Their wealth gets systematically transferred to the government through negative real yields. Let me put this in perspective with a scenario you can relate to. Imagine you owe your neighbor $100,000 on a loan with 2% annual interest. Sounds manageable, right? Now, imagine your income doubles over the next decade while the dollar loses half its purchasing power. You're still paying that same $2,000 in annual interest, but now it represents 1% of your income instead of 2%. And when you finally pay back that $100,000 principal, it only buys what $50,000 would have bought when you borrowed it. You've cut your real debt burden in half without sacrificing anything. Your neighbor is the one who paid the price. That's exactly what our government did from 1946 to 1960. Bondholders, American citizens, banks, insurance companies, pension funds, were the neighbors who got paid back in devalued dollars. The wealth didn't disappear. It transferred from savers to borrowers, from the private sector to the government, from people who trusted in the promise of fixed returns to an institution that could simply change the rules. The question you should be asking right now is this: with our national debt sitting at $36 trillion and climbing, with our debt to GDP ratio back above 120% for the first time since World War II, with interest costs approaching $1 trillion annually, do you really think our government is going to pay this back in full value dollars? Or are they going to open that same playbook one more time? History doesn't repeat, but as they say, it often rhymes. And right now, if you know what to listen for, you can hear the same rhythms starting to play. The Federal Reserve has already begun coordinating with Treasury needs. Banking regulations have already created captive pools of money that must flow into government bonds. The stage is set. The actors are in position. The only question is whether you recognize the performance before it's too late. So, how does the government actually pull this off? How do they make trillions of dollars in debt simply vanish without anyone storming the Capitol? The answer lies in a set of laws, regulations, and institutional arrangements so technical that most Americans never learn about them. But once you see the machinery, you can't unsee it. Financial repression operates through three coordinated tools working in perfect harmony. First, our central bank holds nominal interest rates below the inflation rate, creating negative real yields on government bonds. Second, regulatory capture forces domestic institutions, your banks, your pension funds, your insurance companies, to hold government debt regardless of the returns they're getting. Third, capital controls or regulatory penalties prevent savers like you from moving your money into inflation-protected assets or foreign currencies. The result? A captive pool of domestic savings gets systematically transferred to the government at below-market rates. Over 10 to 15 years, this can reduce debt to GDP by 30 to 50 percentage points without a single dollar of principal repayment. Let me show you the specific laws that built this machine, starting with one you've probably never heard of. January 15th, 1933. The Banking Act introduces something called Regulation Q. Sounds boring, right? Here's what it actually did. It allowed the Federal Reserve to set maximum interest rates that banks could pay on savings accounts. For the next 53 years, banks couldn't compete for your deposits by offering market rates. They were forbidden by law. Think about what this means for a regular American trying to save money. During the 1940s, your savings account paid you 1 to 2% interest, while inflation ran at 5 to 8%. You were losing 3 to 7% of your purchasing power every single year, and there was nothing you could do about it. The law prevented banks from offering you a fair rate. By 1980, the situation had become absolutely absurd. Passbook savings accounts were legally capped at 5.25%, while inflation hit 13.5%. That's an 8.25% annual wealth transfer from every American saver to the banks and their biggest borrower, our government. But Regulation Q was just the foundation. The real game changer came on August 15, 1971. President Nixon appears on television at 9 p.m. Eastern Time, and he makes an announcement that would reshape the entire global financial system. He's suspending the dollar's convertibility to gold at $35 per ounce. The Bretton Woods system, established in July 1944, dies in a single evening television address. Here's what Nixon didn't say during that broadcast. He had just removed the last constraint on unlimited dollar creation. Under Bretton Woods, foreign governments could exchange their dollars for gold, which meant our government had to maintain at least some discipline. With that link severed, the printing press had no limits, and the market revealed the truth almost immediately. Within 2 years, gold was trading at $120 per ounce, a 240% increase that showed exactly how much the dollar had already been devalued. The numbers tell the story. When Nixon made that announcement, U.S. debt stood at $398 billion, about 35% of GDP. That's actually quite manageable, but watch what happens once the constraints are removed. Over the next decade, the money supply, measured as M2, explodes from $685 billion to $1.6 trillion. A 133% increase, inflation averages 8.8% annually from 1973 to 1981. Your dollar in 1971 buys about 35 cents worth of goods by 1981. Now, here's where the magic happens. From 1973 to 1980, Federal Reserve data shows average 10-year Treasury yields of 7.8% during this period. Sounds pretty good, right? You're getting nearly 8% on your bonds. But inflation is averaging 9.2%. Your real yield, what you're actually earning after inflation, is negative 1.4%. You think you're making money, but you're losing purchasing power every single year. Total U.S. debt grows from $458 billion to $908 billion during this period. The government borrows $450 billion. But here's the trick. Debt to GDP remains remarkably stable at 32 to 33%, because nominal GDP explodes from $1.38 trillion to $2.86 trillion. The government borrows nearly $500 billion, but the real burden actually decreases due to inflation. The Federal Reserve Bank of New York, under Chairman Arthur Burns from 1970 to 1978, explicitly accommodates Treasury borrowing needs. The Fed's independence becomes a polite fiction. Have you noticed a pattern yet? Every time our government faces a debt crisis, the solution is always the same: inflate it away while convincing savers they're getting a fair deal. The numbers change, the faces change, but the mechanism is identical. In March 1980, Congress passes the Depository Institutions Deregulation Act, finally beginning to dismantle Regulation Q. But by then, the government has already locked in decades of below-market borrowing. Economists Carmen Reinhart and M. Belen Sprancia calculated the total wealth transfer in their 2015 IMF working paper titled The Liquidation of Government Debt. Their estimate? Approximately $800 billion transferred from savers to the government between 1945 and 1980, measured in 1980 dollars. That's equivalent to $2.9 trillion in today's money. Nearly $3 trillion quietly extracted from American savers over 35 years through negative real interest rates. But then something unprecedented happened. October 1979, Paul Volcker becomes Fed chairman, and he decides to actually fight inflation instead of accommodating it. He raises the federal funds rate to 20% by June 1981, 20%. He deliberately induces a recession to break the back of inflation. Real interest rates spike to positive 8%. For the first time in decades, the debt servicing mechanism reverses savers start earning real returns. The government starts paying actual costs on its borrowing. By 1983, interest payments consume 10.1% of federal spending versus just 6.5% in 1979. The experiment proves something critical. At high debt levels, our government simply cannot afford positive real interest rates. But Here's why Volcker's shock treatment worked then, but could never work today. In 1979, total U.S. debt was $908 billion, about 31% of GDP. Even with interest rates at 20%, the government could manage the payments. Today, we're sitting on $36 trillion in debt, 123% of GDP. If we tried Volcker-style interest rates now, it would consume 40 to 50% of all tax revenue just to pay the interest. The entire federal budget would collapse. Volcker's policy was only possible because the debt was manageable. We're now past the point of no return. And this isn't just an American story. After World War I, France and Italy reduced debt from over 150% of GDP through inflation in the 1920s. After World War II, the United Kingdom inflated away debt from 238% of GDP in 1947 down to 47% by 1980. Again, never paying it back in real terms. Japan attempted this same playbook from 1998 to 2013 with limited success. The institutional architecture is always identical: central bank subordination to treasury needs, regulatory captivity of domestic savers, and controlled currency devaluation. The Federal Reserve Bank of New York serves as the operational center for all of this. It conducts all open market operations, houses the foreign exchange desk, and maintains the primary dealer network through which treasuries are distributed to banks and institutions. When you hear about Fed policy, what you're really hearing about is a coordination mechanism between our central bank and our Treasury Department's funding needs pop quiz. Do you think your savings account interest rate is set by free market competition? Or do you think it's set by a regulatory framework designed to ensure cheap funding for government debt? If you answered the second one, you're starting to see how the machine actually works. The infrastructure exists. The legal framework is in place. The institutional arrangements function exactly as designed. And with $36 trillion in debt that can never be repaid in full value dollars, the only remaining question is when they flip the switch, not if your wealth is sitting in the machine right now and the gears are already starting to turn. September 2024. Our national debt officially crosses $36 trillion. The Congressional Budget Office projects a $1.9 trillion deficit for the fiscal year. But here's the number that should make you sit up and pay attention. With our debt now at 123% of GDP and an average interest rate around 5%, we're paying approximately 6.2% of our entire economic output just in interest. Not principal, just interest. That's $1.14 trillion annually, more than we spend on national defense and rapidly approaching what we spend on Medicare. The math has become impossible, and when the math becomes impossible, the government doesn't change the math. They change the dollars. Let me show you when the machine actually started running at full speed, March 15, 2020 through December 2021, a period of just 21 months that will be studied by economists for generations. The Federal Reserve expanded its balance sheet from $4.2 trillion to $9 trillion. That's a $4.8 trillion increase. To put that in perspective, that represents 40% of every dollar that had ever existed in the American money supply. 4 decades of dollar creation compressed into less than 2 years. The M2 money supply, that's basically all the dollars circulating in our economy, plus savings accounts, exploded from $15.5 trillion in February 2020 to $21.7 trillion by March 2022. A 40% increase. And this created exactly what you'd expect: the inflation spike from 2021 to 2023. CPI reached 9.1% in June 2022, the highest in over 40 years. Here's where it gets personal. Real 10-year Treasury yields hit negative 4.8% in March 2022. Think about what that means for someone who bought $100,000 in 10-year Treasury bonds in March 2020, when yields were 1.15%. They thought they were making a safe, conservative investment. By March 2023, they had lost approximately $18,000 in purchasing power. The mechanism is identical to what happened in 1946, just compressed into 3 years instead of spread across a decade. But September 18, 2024, is when the playbook became undeniable. the Federal Reserve cuts interest rates by 50 basis points. An unusually aggressive move, Fed Chairman Jerome Powell cites labor market softness as the justification. But look at what else happened that same week. The Treasury's quarterly refunding announcement reveals they need $776 billion in net new borrowing just for the fourth quarter of 2024, at restrictive rates of 5.25%. Those annual interest costs would hit $1.14 trillion for fiscal year 2025, exceeding our defense budget of $874 billion and approaching Medicare, spending at $839 billion. The Fed's pause in quantitative tightening begins in October 2024. The message couldn't be clearer. Treasury funding needs supersede inflation control. The Fed's independence lasted exactly as long as the debt stayed manageable. At $36 trillion, we've crossed the event horizon where positive real interest rates would literally consume the federal budget. The Congressional Budget Office released updated projections in February 2025, and the numbers reveal just how trapped we've become. Under current law, and this assumes no recessions, no wars, no financial crises, debt rises from $36.2 trillion today to $56.4 trillion by 2034. That's 135% of GDP. Interest costs alone project to $1.6 trillion annually by then, about 3.9% of GDP. But here's the trap within the trap. Those projections assume average interest rates around 3%. What happens if rates stay at 5%? Then interest on $56 trillion becomes $2.8 trillion annually, more than Social Security's projected $1.9 trillion budget. The math simply doesn't work. There's no combination of spending cuts and tax increases that can fix this. The only solution is financial repression. Hold rates below inflation, devalue the debt, and transfer the cost to savers and bondholders. And the infrastructure is already in place, mirroring 1942 to 1951 almost perfectly. Basel III capital requirements force banks to hold treasuries as Tier 1 capital, creating captive buyers who must purchase government debt regardless of returns. The Treasury Department has extended the average maturity of our debt from 70 months in 2020 to 73 months in 2024, locking in lower rates for longer periods. The supplementary leverage ratio exemption for treasuries, introduced in March 2020 and made permanent in practice, allows banks to hold unlimited government debt without capital charges. The reverse repo facility at the New York Fed absorbs over $500 billion in money market cash, preventing it from bidding up treasury yields. Every piece is in position. So, who wins and who loses when the reset fully activates? The winners are clear. Our federal government can compress debt to GDP from 123% back down to 75% over 15 years with negative 2% real rates, eliminating over $13 trillion in real debt burden without making a single principal payment. Hard asset owners, people who own real estate, infrastructure, commodities, and equities, will see nominal values rise with inflation. If you bought a house in 2010 for $200,000 that's now worth $500,000, you've already experienced exactly this mechanism. Debtors with fixed-rate loans, whether mortgages, student loans, or corporate debt, find their payments becoming easier to service as wages inflate, but payment amounts stay fixed. And the primary dealers, Goldman Sachs, JP Morgan, Bank of America Securities, they profit from Treasury trading spreads and Fed operations. During 2020 to 2021, trading revenues at the 5 largest dealers exceeded $150 billion. But for every winner, there's a loser, and the losses are massive. Bondholders holding long-term treasuries, corporate bonds, or any fixed-rate instruments will see their purchasing power systematically destroyed. There's $10 trillion in U.S. Treasury bonds held by the public right now. At negative 2% real rates, that's $200 billion in real wealth loss annually. Savers in cash, and there's $18 trillion sitting in savings accounts, CDS, and money market funds earning 4 to 5% nominal while inflation runs 3 to 4%. They're losing purchasing power every single day. 46 million Americans over 65 who depend on bond portfolios and fixed income for retirement will experience declining living standards as real yields remain negative for years. And then there's the dollar itself as the world's reserve currency. Foreign central banks hold $7.6 trillion in U.S. Treasuries as of December 2024. They're facing the same losses as domestic holders, which is accelerating diversification into alternatives. Gold has increased from 15% of central bank reserves in 2015 to 30% today. The yuan, despite all its problems, is gaining ground. The reserve currency status we've enjoyed since 1944 is quietly eroding, one negative yielding bond at a time. In February 1946, the United States owed 119% of GDP and made it disappear without repayment. In February 2025, the United States owes 123% of GDP, and the exact same playbook sits ready, not as conspiracy, but as the only mathematical solution. The Fed's independence lasted exactly as long as the debt stayed manageable. At $36 trillion, positive real rates would consume the budget. The reset isn't coming in 2027. It started the moment the Fed pivoted in September 2024. The infrastructure is operational, the mechanisms are engaged, and the wealth transfer is already underway. The only question remaining is whether your wealth is positioned in front of the wave or directly beneath it. History doesn't repeat, but the math is always identical. And right now, the math says your dollars are about to buy a lot less than you think they will.